Why smart money is moving out of us commercial real estate. The smartest money in the world is quietly walking out the door, and they are not telling you why. Blackstone, Brookfield, PIMCO, the sovereign wealth funds of Norway, Singapore, and Abu Dhabi. The institutional investors who collectively manage more capital than the GDP of every country on earth except the United States and China. The entities whose investment decisions are studied, reverse-engineered, and followed by every serious portfolio manager on the planet, are reducing their exposure to U.S. commercial real estate at a pace and with a conviction that has no precedent in the post-2008 financial era. Not repositioning, not rotating within the asset class, exiting, quietly, systematically, with the deliberate, unhurried precision of institutions that know something the retail investor, the regional bank balance sheet, and the pension funds still holding commercial mortgage-backed securities at par have not yet been allowed to understand. What they know is this: the $20 trillion U.S. commercial real estate market is not facing a correction. It is facing a structural repricing that will reset valuations by 30 to 50% across multiple property categories, not because of temporary market conditions that will normalize when interest rates decline, but because the fundamental demand architecture that justified those valuations has been permanently altered by forces that were accelerated by the pandemic and are now irreversible, regardless of what the Federal Reserve does with interest rates. The office market, the retail market, the regional mall ecosystem, the suburban corporate campus infrastructure, all of it built on assumptions about how human beings work, shop, and organize economic activity that are no longer true and will not become true again, regardless of how many return-to-office mandates Fortune 500 CEOs issue. The smart money figured this out 3 years ago. They have been selling to pension funds, regional banks, and retail real estate investment trusts ever since. And the window for everyone else to understand what the smart money already acted on is closing faster than any official narrative about stabilizing commercial real estate markets is willing to acknowledge. Let's establish the specific numbers, because the numbers are where the dark truth lives and where the official narrative most aggressively tries to redirect your attention. The U.S. commercial real estate market peaked at approximately $20 trillion in total value in 2021, the moment of maximum central bank liquidity, minimum interest rates, and maximum institutional confidence in the permanence of pre-pandemic demand patterns. Since that peak, transaction volumes have collapsed by 65%. Not declined, collapsed. A 65% reduction in transaction volume means the price discovery mechanism that tells you what commercial real estate is actually worth has essentially stopped functioning. Assets are not being sold, they are being held, and assets that are not being sold are being valued at prices that have not been tested by actual market transactions conducted at current interest rates and current demand conditions. This is the hidden financial nuke sitting inside every regional bank balance sheet, every pension fund commercial mortgage allocation, every commercial mortgage-backed security still rated investment grade by agencies that rated subprime mortgage securities, AAA in 2006. The valuations are fictional, not in the sense that someone deliberately fabricated them, in the sense that they represent prices from a market that no longer exists, applied to assets whose fundamental demand drivers have permanently deteriorated, held on balance sheets that have powerful institutional incentives to avoid the mark-to-market process that would reveal the fictional nature of those valuations. The office sector is the epicenter of this catastrophe. National office vacancy rates reached 19.6% in 2024, the highest level ever recorded in modern American commercial real estate history, surpassing even the vacancy rates of the early 1990s savings and loan crisis that required a federal bailout of $124 billion. In major markets, the numbers are worse. San Francisco office vacancy is above 30%, Houston is above 25%, Chicago's Central Business District is above 22%. These are not temporary pandemic aftershocks. These are the permanent consequences of a structural shift in how knowledge workers organize their professional lives that has proven resistant to every corporate mandate, every office redesign investment, every free lunch and rooftop terrace amenity that commercial landlords have deployed to reverse it. The vacancy rate matters financially, not just because empty space generates no revenue, but because commercial real estate loan covenants are typically structured around debt service coverage ratios, the ratio of property income to loan payments, that assume occupancy rates above 85 to 90%. At 19.6% national vacancy, a significant portion of the office loan portfolio nationally is generating income insufficient to cover the debt service on loans originated when vacancy was 10% and interest rates were 3%. The loan is not technically in default yet because the borrower is still making payments, often by drawing on reserves, by negotiating forbearance agreements with lenders, by doing whatever is necessary to avoid the formal default that would trigger the mark-to-market reckoning that both borrower and lender are desperate to postpone. This process has a name in financial history. It is called extend and pretend. And it has a known outcome that has never varied in any previous real estate cycle, where it was deployed at scale. The $1.5 trillion in commercial real estate loans maturing between 24 and 2026 is where extend and pretend hits its mathematical limit. These loans cannot be extended indefinitely. They have maturity dates. At maturity, they must either be repaid, which requires either asset sale at current market prices or refinancing at current interest rates, or they enter formal default. Refinancing a loan originated at 3.5% interest into a loan at 7% interest on a property whose income has declined 30% due to vacancy increases does not work mathematically. The debt service coverage ratio fails. The lender cannot approve the refinance without recognizing a loss. The borrower cannot service the new loan without injecting equity that the current valuation does not justify. The transaction cannot close. And when the transaction cannot close, the choices are default, deed in lieu, or distressed sale, all of which force the mark-to-market reckoning that the extend and pretend strategy was designed to postpone. The regional banks holding 70% of all commercial real estate debt are not equipped to absorb this reckoning at the speed and scale the maturity wall demands. The FDIC's Deposit Insurance Fund holds $121 billion, sufficient to manage isolated bank failures, but mathematically insufficient to manage the simultaneous stress across hundreds of regional institutions that the commercial real estate maturity wall will generate between now and 2026. This is not speculation. This is arithmetic applied to publicly available data that the official narrative has been carefully constructed to prevent ordinary depositors and investors from connecting into a coherent picture. The pattern of a debt-financed asset bubble inflating to historic extremes during a period of artificially suppressed interest rates, followed by a structural repricing when rates normalize and the demand assumptions underlying the bubble are revealed as permanently impaired, is one of the most reliably recurring patterns in the entire history of financial systems. It has appeared in every major economy in every century with documented financial records, with a consistency that suggests it is not a market failure but a market feature, a predictable consequence of the interaction between human psychology, institutional incentive structures, and the mathematical properties of compound interest. Study the Japanese real estate collapse of 1990. Japan's commercial and residential real estate market inflated to valuations so extreme during the 1980s bubble that the Imperial Palace grounds in Tokyo were theoretically worth more than the entire state of California. The Bank of Japan kept interest rates artificially low through the mid-1980s to manage currency pressures following the Plaza Accord, a decision that channeled enormous institutional liquidity into real estate and equity markets that had no fundamental basis for the valuations they were achieving. When the Bank of Japan finally raised rates in 1989 to address inflation concerns, the asset bubble did not deflate gradually. It collapsed. Japanese commercial real estate values fell 87% from peak to trough over a 15-year period. The banking system that had financed the bubble, carrying real estate collateral at peak valuations against which it had lent aggressively, entered a zombie state that persisted for 2 decades. Banks that were technically insolvent at mark-to-market valuations were kept alive through regulatory forbearance, government capital injections, and the same extend and pretend dynamic that is currently operating in the U.S. commercial real estate market. Japan's lost decade, the period of economic stagnation that followed the real estate collapse, was not primarily caused by the asset price decline itself. It was caused by the zombie banking system that the extend and pretend response to the decline created. Banks that are carrying impaired assets at fictional valuations cannot perform their primary economic function of allocating capital to productive uses. They are too consumed with managing their own balance sheet distress to underwrite new lending at the scale a growing economy requires. The result is a credit contraction that operates independently of interest rate policy, the condition that economists call a balance sheet recession, where monetary easing cannot stimulate growth because the transmission mechanism of monetary policy, the banking system, is functionally impaired regardless of how low rates go. America's commercial real estate crisis is not identical to Japan, 1990. It is worse in one specific dimension and potentially better in another. It is worse because the structural demand impairment, the permanent shift away from office and retail space driven by remote work adoption and e-commerce penetration, has no historical precedent in Japanese real estate. Japan's real estate collapse was a pure financial bubble correction. The assets retained their functional utility. Offices were still used as offices. Retail space was still used for retail after the prices corrected. American commercial office and retail space faces a demand impairment that is structural and permanent. The correction is not just financial, it is existential for entire property categories. And existential corrections do not produce 30 to 40% price declines, followed by recovery. They produce 60 to 80% permanent value destruction for assets that no longer serve the economic function they were built to serve. The hidden financial force connecting the smart money exodus, the extend and pretend regional bank strategy, and the Japanese lost decade parallel is the same force that operates in every asset bubble collapse in history. The force is this: the institutions closest to the problem always have the strongest incentive to delay its recognition. The regional bank holding $500 million in commercial real estate loans at fictional valuations has an existential incentive to maintain those valuations as long as regulators permit it. The pension fund holding commercial mortgage-backed securities at par has a fiduciary incentive to avoid the mark-to-market that would reveal it as technically insolvent. The rating agency that rated those securities investment grade has a reputational incentive to maintain those ratings as long as the extend and pretend strategy prevents formal defaults from triggering mandatory downgrades. Every actor in the system is rationally incentivized to delay the reckoning. And the collective result of individually rational delay is a systemic accumulation of unrecognized losses that grows larger, and the eventual reckoning more catastrophic, with every quarter that the delay is successfully maintained. This is exactly what happened in the subprime mortgage crisis. The losses were real in 2006. They were recognized in 2008. The 2-year delay between reality and recognition did not reduce the losses. It allowed them to compound, spread through the financial system via securitization structures that distributed the toxic exposure to institutions that did not know they held it, and ultimately produce a crisis that required $700 billion in TARP funding, $4 trillion in Federal Reserve balance sheet expansion, and the deepest recession since the Great Depression to contain. The commercial real estate crisis is following the same timeline with the same institutional incentive structure and the same delay mechanism. The losses are real now. The recognition is being postponed now. And the gap between reality and recognition is growing with every extend and pretend refinancing that kicks another maturity down the road. Watch 4 developments in the next 18 months that will determine whether the commercial real estate reckoning is manageable or systemic. First, watch the FDIC's problem bank list, the confidential regulatory list of institutions with significant financial weaknesses that the FDIC publishes quarterly with a 1-quarter lag. When the problem bank list crosses 100 institutions, it was at 66 in the most recent published data. It signals that the commercial real estate stress has moved from isolated incidents, systemic spread across the regional banking sector. At 150 problem banks, the FDIC's resolution fund math becomes publicly untenable, and federal intervention becomes inevitable. Second, watch commercial mortgage-backed securities delinquency rates published monthly by TREP, the industry data provider whose CMBS surveillance data is the most granular real-time indicator of commercial real estate loan performance available to the public. CMBS delinquency crossed 5% in 2024. At 8%, rating agency downgrade cascades begin. The mechanical process by which securities that fall below investment grade must be sold by pension funds and insurance companies whose mandates prohibit below investment grade holdings, creating forced selling pressure that accelerates price declines and generates the next wave of delinquencies in a self-reinforcing spiral. Third, watch office-to-residential conversion announcements from major U.S. cities. When municipal governments begin announcing emergency zoning changes to facilitate large-scale office-to-residential conversion, essentially admitting that the office market cannot recover within the existing land-use framework, it signals that the permanent demand impairment thesis has been officially accepted at the policy level. Conversion announcements are not bullish signals for commercial real estate. They are the official acknowledgement that the asset category requiring conversion has no viable future in its current form. Fourth and most critically, watch what happens to the first major pension fund that is forced to publicly disclose a significant commercial real estate write-down in its annual report. Pension funds have been the slowest and most reluctant institutions to mark their commercial real estate holdings to current market values, protected by accounting standards that allow alternative assets to be carried at appraised value rather than transaction value for extended periods. When the first major public pension fund, the kind that manages retirement savings for teachers, firefighters, and government employees across an entire state, discloses a commercial real estate loss large enough to materially impair its funded status, it will trigger a re-examination of every other pension fund's commercial real estate valuations simultaneously. The domino is not yet tipped, but it is standing at the edge of the table. And the smart money that already moved is watching from a safe distance. Here is the final truth. The smart money did not move out of U.S. commercial real estate because they are pessimistic about America. They moved because they are rational about mathematics. Because they understand that $1.5 trillion in maturing loans, 19.6% office vacancy, 7% refinancing rates applied to assets underwritten at 3.5% rates, and a regional banking system carrying those loans at fictional valuations is not a set of conditions that resolves through patience and extend and pretend. It is a set of conditions that resolves through recognition, forced, painful, systemically disruptive recognition that happens either in controlled stages or in an uncontrolled cascade, depending entirely on whether the institutions managing the delay have enough runway left to control the timing. The smart money does not wait for the cascade. It moves before the runway runs out. It moved 3 years ago when the vacancy data made the structural impairment undeniable to anyone running the numbers. Honestly, the window for everyone else is not closed, but it is closing. And the institution sitting on the other side of the smart money's exit, the regional banks, the pension funds, the retail REIT investors still holding at 2021 valuations, are going to discover what the smart money already knew. Not gradually, not gently. In the specific brutal financially catastrophic way that every extend and pretend cycle in history has ultimately concluded, the smart money has already moved. The question is not whether you understand why. The question is whether you understand it in time to matter.